thinking about selling your rental but are concerned about the tax consequences? Do you love the income that your rental produces but are thinking that there might be something more available to you? Are you tired of rentals altogether but are concerned that the 1031 exchange is your only option in order to avoid massive tax consequences? Are you concerned that after a multi-year run-up in the market that if you sell your rental at this time and buy something else, that you're going to be pressured into buying not such a good investment and that things won't work out for you? You've heard the term buy low and sell high, but how does that work if you want to sell your rental now and trade up to something else that's also high priced? How do the numbers work then? If you do a 1031 exchange and you do think that this is a good time to trade up to something better, well, what do you need to know right away before you take that action to sell in order to benefit yourself in doing a 1031 exchange properly early? Whether you're fine with trading up your rentals through a 1031 exchange or doing something else, if you're tired of tenants, termites, troubles, and taxes, then you've come to the right place, because we have some tax hack strategies for you in this video, which will really help you to think about this before you make that big move. Now, although I am not a CPA or a tax professional, I do work in the real estate industry and so have come across some really great strategies that I would like to introduce you to so that you now can take these to your professional and start putting your thinking cap on, start being a smart seller before you sign on the dotted line so that you can maximize your gain and minimize what you're paying to the IRS. It's time for you to make your money work hard for you again and not just needlessly give up your money to Uncle Sam because you didn't know. Now's the time to get informed. After today, you can't say that you didn't know. Listen to the end and we'll give you a checklist which will help you to make sure that you've covered everything to bring to your tax professional when considering selling your rental. So listen up, be informed, and make smart decisions as a smart seller. What I've done on this video is interviewed a friend of mine, Linda, who loves talking about tax strategies. And so listen up and enjoy what she has to say and share with you today.
Well, good afternoon, everyone. This is Ginger Faith from Golden Canyon Properties here in sunny Livermore, California. And I'm here with one of my partners, Linda. And Linda and I work together to help sellers pay zero or very little capital gains tax when they sell their investments without necessarily using a 1031 exchange, although that's a great strategy as well, particularly when you're working with rentals. And Linda is an expert in this matter, and she is great at articulating different strategies. Linda and I are not CPAs or tax advisors, so please check with your licensed professional. But we are real estate professionals who help people buy and sell, and we often work with investors. The realtor often is the person that you need to be on your side when strategizing best ways to offload some of your investments. And so with that in mind, we realize that we really believe that this is a very important subject, and we want to help you to save as much money as possible in your strategies. One of the things that we'll be talking about right now is simply what are capital gains taxes. And Linda, would you just pipe in now and tell us what is the capital gains tax and why should sellers be aware of that?
Thank you very much, Ginger. Yes, we definitely want people to go into any transaction that they're considering with their eyes wide open and fully informed about what their outcome is going to look like, because we certainly have situations, and I know you've had conversations with clients, and I have too, where they sold something or they're in the process of selling something and they haven't checked with their tax professional, and they can oftentimes end up with a very nasty surprise. And so optimally, what we want to do is we want to work with sellers in advance of even going on the market, because once you're on the market, as you get closer and closer to close of escrow, there are fewer and fewer options available for managing capital gains tax. And so it can oftentimes be very difficult at the end if you find out at the very end that you've got an enormous tax bill that is looming. And so we certainly want to have that conversation well in advance and do some planning well in advance. And one of the best returns on investment you can get is by doing some, very strategic advanced tax planning in advance of transactions that you participate in and selling things and what have you. So we definitely want to take full advantage of our time. And so one of the things that what you just asked about, what is capital gains tax, and it seems like kind of an elementary question, but this is the thing that I discuss with people all day, every day, and oftentimes people really don't know what their liability is at all. And when they do go to talk to their tax professional, sometimes they can get a little bit of a mixed message, and they don't really have a clear understanding of how capital gains tax is, how the government looks at gain and how it flows on their tax return and how it is that they're going to be taxed. And so that's a very, very key part of all of this, because if you know how you're going to be taxed, you know how, at least that's a starting place to learn how to manage that tax in such a way so that you can keep as much of your profit in your pocket and out of the government's pocket as possible. And the good news is the U.S. tax code is available to every taxpayer. It's available to everyone. It's not just the very, very wealthy who have teams of attorneys and tax professionals that do their magic. Those teams of attorneys and tax professionals use the same tax code that's applicable to every single seller. And so that's the good news, is that we all have, it's an equal opportunity tax code. So we'll just do a really quick, what is capital gains tax, and then move on from there. So capital gains tax is the spread between what you sell your property for and what you have into the property. And so what that, the definition of those two descriptions are what you sell your property for less selling expenses. So commissions and closing costs and other maybe, buyer closing costs or something, any selling expenses that the seller is responsible for is deducted from the selling price. And so then you're looking at a net sales proceeds. So that's the starting place that the government looks at, is what's your net that you received, and then they deduct from that what your net adjusted basis is. And so the way to figure out net adjusted basis is what you purchased the property for initially, any improvements that were made on the property. Now, improvements are there's a difference between improvements and replacement. And so improvements are putting a new kitchen floor in is an improvement. Changing a couple of tiles, that's a repair. So it depends on what was done and if you have receipts, and all of those things need to be discussed with the tax professional. But the way to figure out what your net adjusted basis is purchase price plus money that went in for improvements minus any depreciation that was taken over the time that, if this was an investment property, over the time that it's been used as an investment. And so when you add the two numbers and deduct the depreciation, then you get your net adjusted and your net adjusted basis. So then what the government looks at is the spread between the net sales proceeds and net adjusted basis. And so whatever that number is, that spread in between those two numbers is what the government looks at as, and what they call it is realized gain. And so the government is going to tax us on our realized gain. And loans don't matter. Oftentimes, and I talk to people about this all the time, and I have realtors that we'll have conversations about it, and they don't understand, people that don't deal with this every day, that loans don't make any difference in the way that the government looks at that number. So the spread between net sales proceeds and net adjusted basis is the spread. If someone has borrowed against their asset and taken a lot of that money out and used it to buy other assets or whatever, they still have to pay tax on that spread. So it doesn't matter if there's any loans in there. So that's what capital gains tax is, and that's what the government looks at as far as what is taxable. So then you've got your federal, which is in our area. So Ginger, you're over in the East Bay, and I'm in Silicon Valley on the other side of the bay. And so over here we have significant appreciation, and so oftentimes the sellers that we're talking to they have $1 million or more in realized gain after deducting for anything that they're qualified to deduct for, like the principal residence exclusion. We'll talk about that in a minute. Anyway, so we've got that spread. The government, if that number is above $479,000, then that puts the seller into the 20% tax bracket on the federal side. And so what they're looking at on their tax return is a 20% tax on that spread if it's over $479,000. If it's under that, then it's taxed at the 15% tax bracket. And if they can get their adjusted gross income down below, I think it's $77,000, I think that they can, it can be taxed at zero. But a lot of work has to happen to get your adjusted gross income down into the zero tax bracket on the federal side. In the state of California, part of the reason why this is such a big deal here in California is because we have the highest tax rate in the entire nation. And so that spread, that amount of realized gain, is going to be taxed at ordinary income rate in California, which usually the numbers that we're talking about with sellers, it's at 13.3% in California at ordinary income rates. And then, if that isn't painful enough, then we have Obamacare on top of it, which is a 3.8% surtax. When Obamacare was voted in, they added that in. And so that's another tax on top. And then if there's depreciation recapture, then that's taxed at 25%. So there's all of these different categories that we have to look at, and we have to take that spread and run them through all these different categories. And so, and I think, Ginger, you have the calculator that we use that can help run those numbers really quickly for a seller. So if they're interested in knowing what their tax might look like, and again,
it's
we're
a
not
great
tax professionals, but
help.
math is math.
So, you see how it's so important to do this well ahead of your deciding to sell a property. Because there's so much going on when you're in, you get a buyer and then you're in escrow. There's so much going on. You got to be thinking about this well in advance. And what you're telling us right now is so important, right? Yeah.
Oh, absolutely. Yeah, it's the well in advance. The closer you get to close of escrow, the fewer options you have. And so it's optimal to be really looking into this diligently before even going on the market. However, where we are in the market cycle right now, we don't want to wait too long because we've got a shifting market, and so we want to capture as much of our equity as possible. And as time goes on, our market is shifting, and so we're deflating some. So we want to take advantage of our equity position as much as possible, as quickly as possible. So we want to get after it. If you're considering selling something, we want to.
It's a good time to think about it, for sure.
Right.
Yeah.
Get educated about all of these different things. So anyway, so that's the spread, and that's what capital gains tax is. And then a little while ago, I think you were talking about the different areas of the tax code that.
Yeah, could you address it? There are various ways and various strategies, and that's what I'm excited about in this conference call is we have options. And if we plan ahead, we can tailor make an option that's best for us. So could you speak a little bit, Linda, to the different tax codes that allow for capital gains tax management?
Yes, absolutely. This is where we get into the fun part. It's depressing thinking about the 20% and the 3.8 and 13.3. It's depressing thinking about that. But so now we're going to get into the fun part where we actually can do something about that. We don't have to be victims. We can do something about it. So there's 3 areas of the tax code that are specific to capital gains tax. And we actually, the great news about all of this is we actually can combine different areas of the tax code together to have even a more powerful result. And so if we know what we're doing and we plan well enough in advance that we can set this up appropriately, then we can combine different areas of the tax code, and we can keep a lot more of our money in our pocket at close of escrow than we would if no planning were done. So the 3 different areas of the tax code are Section 121, Section 1031, which many investors are already familiar with the 1031, and then Section 453. So Section 121 is the section of the tax code that provides for the principal residence exclusion. And so if a married couple is married and lived in their primary residence for 2 of the last 5 years, then they are able to exclude $500,000 from the gain. And if they're not married and they're single, they can exclude $250,000 from the gain. And so that's one strategy. And a lot of sellers they'll live in a property, they'll move back into an investment property and live in it for 2 years so that they can qualify for that 121 exclusion. And so, so that is a strategy. However, the good news is it's not necessary. You don't have to do that. We can get around that, or we can work with your tax professional to get around that so that you don't necessarily have to disrupt your life and go live somewhere you don't maybe not want to really live for a couple of years. But that is one section of the tax code that provides for, tax reduction is the Section 121. And then there's the 1031, which many investors are familiar with the 1031, and that's where you sell your relinquished property and you use the proceeds to buy a replacement property. A 1031 exchange accommodator is involved in that transaction. And the reason that works is because the sales proceeds that come from the sale of that relinquished property go to a 1031 exchange accommodator and stay there for safekeeping while the seller is looking for a replacement property. And so the reason that whole thing works is because what we want to avoid is what's called constructive receipt. And so with a 1031 exchange accommodator involved, constructive receipt does not happen because constructive receipt means that the seller has received their money. And so what happens is the title company wires the money to the 1031 exchange accommodator and it stays there, so the seller has technically not touched it. And so that's how it is that they're able to not pay tax on that money and they can use it to buy a replacement property. The challenge, as many of us investors know, is that you have a lot of landmines involved in a 1031, and the biggest landmine is the 45-day identification period that is required that you have to identify a replacement property within 45 days of close of escrow. So close of escrow is close of escrow day. The next day is day 1. You have 45 days to identify up to 3 replacement properties, and there's a couple of other variations in there of identifying replacement properties as well. Like you can combine you can use the proceeds from one sale to buy multiple properties, and there's different things that you can do. But the 45-day identification period is the biggest hurdle and the biggest landmine, and that is the most difficult for people, especially in this type of a market. And one of the other big things about
I've seen nightmares with this.
Yeah. And
where someone is forced to buy a subpar property just in order to comply, and then they end up with a lemon. They end up with a nightmare, bad tenants, etc. I've seen big issues with that.
Yeah. Well, not only do they end up with a lemon, but they've oftentimes overpaid for their lemon. Which we certainly want to help our clients avoid doing that. And another thing about the 1031 is it puts a seller in a position of a sell high, buy high situation, or where we're in the market cycle right now is we're high right now. So great, sell your property now, get all that equity. But the problem is if you're doing a 1031, you've got to buy another property we're selling high and buying high. So you're buying it high. And so, as every investor knows, what you want to do is sell high and buy low and then ride the appreciation up. Yeah, but that's impossible to do in a 1031 because you have to identify within 45 days and then you have to close escrow within 180 days. And so
that's a very, very valid point.
I'm sorry, say that again?
That's a very valid point. Very, very important point.
Yeah, and so it is a strategy. It takes, nerves of steel, I guess, to be able to fully execute. It's very, very stressful. That 45-day thing is very stressful. But anyway, so that is a strategy. There are others. And so the next part of the tax code that we're going to talk about is Section 453. Section 453 is the installment sale reporting section of the code. And so the way an installment sale works is a seller can sell to anybody, and if they want, and if they're in a position, they can carry the paper. And so if someone has a very highly appreciated property and they don't want to pay the capital gains tax all at once, they would rather pay it in installments over time as they receive it, then that's how the installment sale section of the code works, in that as their gain is received, then each year they will report that gain at the end of the year, and on their tax returns they will pay tax on the gain that they actually received. Now, the good news is there's a bunch of different iterations of Section 453 of the tax code that provide for all kinds of different ways of managing the capital gains tax. And so there's a straight installment sale where, like, Ginger, if I was going to buy your property and you were going to carry the paper, I would be making payments directly to you, and then you would be reporting the gain at the end of the year on your taxes. And so that's the traditional installment sale. But there's other strategies that provide for using trusts, where you can put a property into a trust, and then there's a payment stream that happens. There's another strategy that also involves a payment stream type of a thing. However, with that one, they have an arrangement set up so that the seller can actually receive a tax-free lump sum at close of escrow. So that's a different strategy. That's actually one of the favorite ones. And then there's a few other strategies that also use trusts, and then the money that's in the trust is then invested in, like, treasury bills and different things like that. And then there's also trusts like the charitable remainder trust, where a seller can receive a huge tax deduction actually on their tax return for giving their property to charity. So they would set up a trust, and all of the trusts and everything else, all of those need to be, that's an attorney, a tax professional that the seller would need to go and talk to an attorney about setting up that type of tax management system plan. And so anyway, so the charitable remainder trust, and then there's other forms of trust as well that the seller can receive charitable deductions and what have you. So there's a lot of different things that can be done we just want to start well enough in advance and talk to the right tax professionals and get the right people involved and have the seller understand the mechanics of whatever strategy they, works for their situation, because everybody's different. And so, whatever the seller decides is the right thing for what their goals are, then they can go about setting up, being sure that they really understand the mechanics of it and what the results are going to be at the end. And if it's, if the end result is going to meet their needs or partially meet their needs, or, a lot of times what's really important is for the seller to figure out exactly what it is that they're going for. What is it that they want to do? Figure out the goal first, then figure out how to get to the goal,
Well, the exciting part is that people don't realize that there are plenty of strategies.
Absolutely.
And sometimes they have a goal, but they're thinking, well, the 1031 doesn't fit in really with what I want, but this is all I know, and this is all my advisors are telling me because this is all anybody knows.
Right.
So the more options you have, the more successful you're going to be in meeting the goal. So number one, know what your outcome is, and number two, find people who can help you to actually meet that outcome, right? And you're offering some really great opportunities that people probably don't even realize.
Yes, absolutely. And we want to fully utilize that tax code because it's for all of us. It's all those different areas of the tax code are all there for all of us. And so they're not just for a select few or the 2% or, it's for all of us. That tax code's there, for all of us to benefit from. And so, really doing your homework is, pays off in spades for sure.
Well, excellent. I know, Linda, you just said you recently did this for yourself, and you saved a ton of money. So you don't have to tell us all the details, but that was a very exciting story that you actually planned ahead and then saved. So, they say it's not what you make, it's what you keep. So
That's right.
make it, and then figure out ways to keep it. And so This is very exciting. So any other alternative investments that once a person, let's just say they are able to get the money and now they haven't done a 1031 exchange, so they are not locked into another property, a physical property. Are there strategies within the tax code that will allow them to invest in other things? And if so, what are some other alternative investments that people might consider investing in that don't have the same management hassles that rentals do?
Excellent question. Absolutely. There's many different things that people can do, and that's, oftentimes people who have highly appreciated real estate, that's what they know. And so they're comfortable with that. And they get kind of locked into it because they understand it and they're comfortable with it. But after 30 years of managing properties, I can't tell you how many clients that I've met with that they're just tired of it. Their properties are fully depreciated, so they're not realizing their full benefit of owning real estate anymore, and they don't want to do a 1031 because of just all the stuff that we just talked about. And so they're feeling very stuck, and they would like to do something that's less management with their equity, but they don't know how to get it out, and they don't know what to do with it once they get it out. So, we work along all those lines and help with all of that stuff. So one of the things that someone could do is they could sell their highly appreciated asset. They could liquidate that property. And like I mentioned before, we do have one strategy that does allow people to walk away with a lump sum. And with that lump sum, they're able to then reinvest that money in any asset class they want on any time frame they want. And they're not locked into the 45 days or locked into having to buy another piece of real estate. If they want to do notes, they can do notes. And that's one thing that I do is I invest in notes, and the benefit and the beauty of investing in notes is you don't have the liability of owning a piece of property. You don't have the management headaches. You're the lender on the property. And generally speaking, if there's some sort of if someone stubs their toe on your property and decides to sue you.
Every landlord knows the story.
Toe,
every landlord has the nightmare stories.
Oh, absolutely. Somebody has a problem of some sort and they see, deep pockets and they think they want to maybe relieve you of some of your, what you have in your deep pockets.
Hard-earned income, yep.
Exactly. Then they, property owners get sued all the time and people lose assets that way. Well, generally speaking, a lender is never sued. A lender on a property is never sued. A property owner may be sued, but as a lender, lenders don't get sued for owning notes on property. So that's one option of what to do with your proceeds from your sale is invest in notes. And that's a whole big subject in and of itself. That's performing notes, unperforming notes, all kinds of different things. So notes is one thing. The other thing is if someone does want to buy, they like real estate, they've had a good experience with real estate, they do want to buy an up-leg piece of property, but maybe they want to go out of state and they want to take their time and they want to find the right property, or they want to maybe sit on those proceeds for a while and let the market do its thing and then go back in and invest when we hit the bottom, at the bottom of the next cycle. And so, we have a way that we can do that. We can have them be in a position that they're able to sit on the proceeds and wait until they can find the right property for the right price in the right market at the right time. And so that's another thing. And then the good news around that is in that scenario, they would be able to start their depreciation schedule all over again. They would get a brand new, shiny depreciation schedule.
Yeah.
That starts at purchase price. So then now, so like in a 1031, in a 1031, you have to carry forward your whatever's left over from your depreciation schedule from when you started with your first investment property. So you have to carry forward your depreciation schedule. If you add money into the deal, then you're able to start depreciation over again on the new money that goes into it. But if you don't do that, you're continuing on with not benefiting from, fully benefiting from owning real estate. And so with this other way of doing it, we're able to help people start a depreciation schedule all over again. And so if you can be very strategic about buying your up-leg property, you can fully benefit. You can benefit from the new depreciation schedule, but you can also benefit from buying the right property at the right time. And so that's an exciting opportunity for our sellers as well. And then another idea, there's many, many different things that people can do with their proceeds. But generally speaking, people who are in real estate understand real estate, and so they like real estate. So another option that's less management but often good returns are investing in syndications. There's lots and lots of companies out there that will buy, large investments like, bank buildings and apartment complexes and commercial buildings, factories, things like that. And so then investors can buy shares into, they can buy into those syndications and buy shares. Now, you can't 1031 into a syndication. And so with one of the other strategies that we've been talking about where you're able to have lump sum proceeds, then in that situation you can then, because a syndication is considered a security, so you can then invest in a syndication through that method, and that would provide for, when you buy into a syndication, generally you're able to participate in the depreciation and participate in the the interest write-off from the loans and the different things that the benefits of owning real estate, you can benefit in whatever your share of the syndication is. And so that's another alternative investment to actually owning a piece of property that you have to either manage the manager or manage the property yourself and deal with the tenants. what have you.
I just need to make a side note in whatever you choose to invest in, do your own due diligence because there's risk with any type of investments. But Linda's giving you some really great opportunities and options to look into and to underwrite yourself.
Absolutely.
Yep. So, well, Linda, this has been amazing and fascinating. And is there anything else that you'd like to share with our audience here today? I think this has been really wonderful, very value rich, and anybody can take this information and really help them to develop better strategies to save money, keep money working for them, and not just give it away to the government. And you've helped us to really appreciate that the tax codes are made for investors and for people who understand the value of investing in our economy, in the American economy. And so by using these strategies, you really have helped us to be able to think about and plan better. Is there anything else that you'd like to share with us before we complete?
Well, just one what you just said about invest in the American economy. I do want to, I would like to mention that a little bit because, people are afraid, as a country, we've been conditioned to be afraid of the IRS, So
True.
people are leery of looking into these types of things because they're afraid they're going to get audited and they're just afraid of the IRS. Well, the truth of it is the Congress is who writes the laws, not the IRS. The IRS is just an enforcement agency. So as long as you're following the laws, even if you get audited, you're okay because you're within what Congress wrote. You're within the laws. And you want to, I wouldn't recommend ever showing up for an audit yourself. You always want to have your tax professional represent you in an audit. That's a much better way to go. But anyways, what I started to say about the investing in an American economy, at first blush, it sort of feels like, oh, we're getting one over on the IRS and we're going to keep all of our money and we're not going to give our money up to the government and, they're not very responsible with our money, so why should we give them more? And, there's all of that kind of mindset that's going on. However, another way of looking at it is the different places of the tax code that provide for managing for capital gains tax are there, and they actually even benefit the IRS. Everybody wins, including the IRS. And what I mean by that is, Ginger, you know this too. We talk to people all the time that feel like, yes, I would love to sell this, whatever thing, but I'm going to get killed in taxes, so never mind. So what happens in that situation?
The economy stagnates.
Exactly. There's no forward movement. There's money not in play. There's it stagnates. That's an excellent word. And
the processional effects of somebody selling a house is many people are employed, and there's a movement of the money. There's a house seller, there's a house buyer, there's realtors involved, there's contractors involved. The IRS gets their money. Everybody. There's money movement. There's progress.
In that, there's a lot of transaction fees that happen, and all those fees, all of those things, the realtors who receive a commission on helping a seller sell and a buyer, their money is ordinary income, so they're taxed. There's tax money there. There's tax money on the transaction fees. There's the contractor who remodeled the kitchen, his revenue that he made is ordinary income that's taxable. So these strategies are there for a reason. They are there to utilize so that it keeps the economy going. So that if everyone just sat on all their properties and never did anything, like, say, for example, capital gains tax was 75%. Nobody would ever sell anything, and the economy would just do nothing. And because real estate is a huge segment of our economy and GDP, and how millions and millions of people earn their daily keep that is somehow or another related to real estate. So these tax provisions that are in the tax code help everybody, including the IRS. So don't be afraid. don't be afraid of the IRS. Talk to your tax professional. Call Ginger. Ginger has a calculator that she can walk you through your numbers and then give you a copy of that, and then you can take it to your tax professional and start the conversation. Start the conversation. Start mapping out what it is that you want to do to figure out your goals, and then start working towards those goals. And now is a brilliant time to be working on that because we're at the top of the market right now. And
yeah,
Ginger, I don't know if you saw this or not, but Zillow is calling for a recession in 2020. There's an article on their blog. So there's noises that we're moving in that direction. And so if you're even mildly considering making a move, I would certainly encourage all of our listeners to contact you and start the conversation and see what those numbers actually look like and what are some of the other investments that they can maybe move into that maybe they can resuscitate some of their debt equity that's sitting there doing nothing right now in the California market, and move it out to other markets or move it into other types of investments that provide for better cash flow and less management and less headaches and just better.
Great. Thank you. Linda, thank you so much for this time. You're such a great teacher, so I wanted to spotlight you. You are able to break things down so simply for people to understand, and I'm so grateful for the time that you're spending with me to do this.
Oh, absolutely. I appreciate the invitation. This has been super fun, and I love this because it's very empowering. And as you talk to lots of sellers, our sellers oftentimes feel, trapped and stuck, and that they don't have options. And so it's wonderful for them to realize that there's actually a number of options, and there's a number of different things that can be done. And we are here to help. We're here to help our clients achieve their goals, and I certainly encourage everyone to reach out to Ginger and learn more about how she can help. And thank you for inviting me. This was really fun.
Very good. Okay, well, everyone, thank you very much for joining us. And signing off, this is Ginger Faith from Golden Canyon Properties in beautiful Livermore, California. If you'd like to know more, feel free to reach out to me at ginger@sellyourbayareahome.com, and I'll be happy to run through a tax calculator with you for you to bring to your CPA or tax advisor and get the conversation rolling on how you can save money on your next sale of your asset. All right, everyone. Have a great day. Bye-bye.